Welcome to the Banking with Life podcast. My name is James Nethery. I'm your host.
I'm Ryan Griggs, your co-host.
In today's episode, we have a conversation about life insurance illustrations, rates of returns, dividends, guarantees, misconceptions, the actions of the owner of a policy, and then we even talk a little bit about Red Dirt Cowboys.
My gosh, get to it.
All right. Thanks for listening. Look, what we decided to do today was just have an unscripted. Yep, he takes a lot of notes. No, really, it's unscripted, which none of them are really scripted anyway.
We don't know how to play by a script.
Well,
I don't.
If I had a script, I couldn't follow it. I promise. No, wait. I mean, in the life insurance business, the financial world, somebody's always trying to give you a script.
That's fun. Yeah.
But we decided that we were just going to talk about illustrations today.
Oh, okay.
Sounds
good to me.
Unscripted with a topic.
Yeah, illustration sounds good to me. What did you want to say about those? Did you have something?
There's so much to say about illustrations, and we're gonna, have a chat here. But there will be more to follow, right? But I don't know. I mean, isn't that one of the most common questions? Send me some illustrations, or
yeah. Have you been getting asked that recently by individuals? I want you to send me some illustrations. Why isn't that a good idea?
We get asked that,
or is it
quite often? Just run me some numbers, and we have a process in our practice, and that's not where we begin or end. Mm-hmm. So, no, we don't just send out illustrations.
Yeah,
but. Yeah, I have a few things to say about illustrations. We're specifically talking about life insurance illustrations in this episode. Number one, they're numbers on a page. They're wrong as soon as you hit print. Mm-hmm. And the outcome is not going to be what's illustrated. It's either going to be better or worse, more death benefit, more cash value. Depending on most of the things that it depends on, you can't control. You can't control the interest rate environment. You can't control the dividend scale of a life insurance company. And I appreciate all the listeners. I really do, and I appreciate your questions and interactions. And but for those of you who have maybe not listened as much as others. When we use the word dividend, we're specifically talking about dividends paid on dividend-paying whole life policies issued by mutual companies. So that, clears the field out of most of the products that Wall Street and the insurance industry has created and foisted on the unsuspecting American public. Mm-hmm. But does that get you going in the right direction?
Yeah. Well, I've had people ask. I was on a call recently with an individual who had read Nelson's book, or some of it, half of it, some of it. He had read a portion of Nelson's book.
Did he read it or peruse it?
Well, if we even say, I read half of it, it's like, well, did you?
Which half?
Yeah. So it's, take that for what it's worth. But hey, he did something, did more than greater than zero. So, and we talked for maybe an hour and a half, and it kind of ended where it's like, well, I got to see the numbers. And it's like, okay, yeah. Well, it's
don't leave us hanging. What'd you do? Did you send him
I didn't. No. This was a call for another agent. Oh. So I was.
Did you pull out a calculator and say all the numbers you want? Is it right there in your pocket?
No, and then in fact they asked too. One of the questions was, can you quantify via an illustration? Can you quantify the internal rate of return or the growth rate, some number to encapsulate what whole life, what IBC is, in order to compare it to something else, in order to compare it to a conventional financial asset. And so I had to explain that there are people out there who will do that, who will take an illustration, who will then use whatever sort of software they might have to
manipulate the fire out of the numbers on the page.
Yeah, and then you can calculate an internal rate of return and discount it to the present in order to capture some quantitative measure of the growth of the cash value. And so I acknowledge that. I know that's out there, but I don't think it's very helpful, because one thing that we've talked about recently is that it sort of indulges that mentality of applying conventional financial analysis to dividend paying whole life and IBC. And it's just, we're crossing our categories. Infinite banking and whole life are not investments. They're not any kind of retirement assets. They're not something that's supposed to generate a regular cash flow, like some sort of maybe a real estate investment that you might control. So to think about the asset, whole life, and to think about the process, infinite banking, with a conventional mindset is just going to sidetrack you. You'll get stuck on particular cul-de-sacs. It's just if you look at the cash value, leave out the death benefit. Death benefit has legitimate value. If you look solely at the death benefit, you leave out the cash value. And then on top of that, like what is it worth to have access to your lifetime profits 10 years from now?
Well, pick a number, put a rate on that.
Right. And where is that on the illustration? And what's the appropriate discount rate to present value it?
Pick a number.
Pick a number. And you've talked a lot about the role of arbitrary numbers in conventional financial planning. We're just reverting to that.
No question.
Of just pick something arbitrary. Pick something of arbitrary value. Maybe it's the cash value. Maybe it's the death benefit. Maybe it's the dividends. Maybe it's the annual growth in the cash value. As soon as you hone in on something, you're leaving out other parts that have legitimate value. Not to mention just the fact of having access to capital later in life for whatever opportunities or unexpected, I don't know what the negative converse of opportunity is, but something unfortunate happens. The value of being prepared when those things happen, and they will. What is that? Of course that has value, but what is the value?
Right. Well, it's fair for someone, all of us, if we're considering putting our capital anywhere. We've all been trained and live in the construct of rate of return today. That's all you can really talk about. So that's almost a default, right, wrong, or indifferent, that, what's your rate of return? Which reminds me of Will Rogers. And he said many things, Red Dirt Cowboy from Oklahoma, right? And if you haven't watched any of his trick roping, you need to YouTube him.
I don't even know half the words you're talking about.
Well, thank God this is recorded. You could play it back, okay? Will Rogers.
Trick roping, Will Rogers. I know that Will Rogers has been quoted frequently, and Nelson quoted him, but
everybody in the world has quoted him. And one of Nelson's quotes was, one Nelson liked and used often, right, of Will Rogers was, I'd rather have a return of my capital than a return on my capital.
That's great.
It's pretty important.
Yeah.
But, don't jump over that. Look, really, Will Rogers, trick cowboy, trick roper, right, cowboy. Okay. So it's a legitimate, what is a rate of return? What is, my God, pick an expected rate of return, a discount factor. Fundamentally in the financial world, there's, present value, future value, the time period, the rate of return, and the payment. You can calculate a return on anything, right? But you're still using some arbitrary numbers, discount and an expected rate of return. Well, hell, if I made, 20% on a real estate deal, now that automatically becomes my expected rate of return. Right. And in that, function right there, we're leaving out taxes. Right. Yeah. We're leaving out the inflation rate, but you adjust for that, or you consider that into the discount factor and the expected rate of return, or, one or both. So I'm just saying that, of course, it's legitimate to get an idea of a rate of return, but that is so... You should get past that quickly, very quickly.
Just keep on sailing.
The idea that you buy life insurance based on illustrations is damn near a train wreck.
Or on the idea of guaranteed rates of return. Like, that's the pitch that is out there that that I've heard of, well, you can get 4% guaranteed on your money here. Why would you do X or Y?
Yeah.
I don't know how you can come up. Maybe someone could explain how that number comes about.
I think that we can touch on it, but that really, that should be addressed in a standalone conversation.
Yeah.
If you take the dividend and leave it at interest on the company, they're going to pay you 4%.
Okay.
All right. That interest rate is not anywhere in the dividend and the action of a life insurance cash value dividend paying whole life. I'm just saying that there's not a function of interest rates on there other than the interest that the company will pay you. If you, like in the example, we talk about a dividend, right? So a dividend is paid. That's not guaranteed. Dividends are paid by mutual companies. And the dividend published scales, right? And they're anywhere from, this is July 2019. Okay. The published dividend scales are anywhere from 4.1 to about 6.1, somewhere around there. And we've talked about dividends in the past too, right? But it's okay. You can't bring it up enough when you're talking about the infinite banking concept and life insurance. So those are the published scales. If I put 100,000, 10,000, 1,000, whatever, if I pay a premium, put money into the policy in the form of a premium, and I have access to, 6,500 or 7,000, whatever that number is, and you can manipulate the illustrations to build something to show to a prospective client that really looks good. And all you can see is the numbers on the four corners of that page. You can't see or necessarily know what happens to those policies that are contorted and twisted to make that illustration that's palatable for someone to say, oh, that looks really good. I'm going to put all this money in there. Okay. So the dividend is paid by mutual companies. The dividend scale is what is not guaranteed. If I pay a premium in year one, and whatever the number is, I'm going to use round numbers for me. If I pay a $10,000 premium and I only have access to, $7,000 at the end of year one after the dividend is paid, although the majority of that $7,000 is accessible very quickly, that's a net loss. I don't care who you are. I don't care what calculator you use.
That's not a 4% return.
No. And then let's say that the dividend in that example may be, let me think for a minute. Maybe that dividend is $150.
Yeah.
Whatever it is,
Small,
it is.
Yeah.
All right. How do you get a 5% rate of return? Is that a 6% dividend? Is that a 5% dividend?
No.
4% dividend?
No.
But the published scale is 4.5 or 4 or 5, whatever it is.
Yeah.
And you can't control the dividend scale. Neither can I.
Nobody can. No one person is going to control.
The life insurance companies only have a limited amount of control, don't they?
Limited amount.
Now, of course, you get a big company that has a lot of cash laying around. They can subsidize their dividend. Mm-hmm. Ooh, that's.
So let's say a couple things. So the dividends that are advertised, that rate
published,
that is published and advertised by the various companies, that is a gross crediting rate.
That is a gross dividend scale,
and it has little to no relation to what an individual actually receive in the form of their dividend for their policy.
Well, no, there is a relation, but the policyholder should not expect to see, if I paid a $10,000 premium, I should see a $600 dividend.
Yeah.
Right. So whatever the dividend is, illustrated at, and received, okay, in my example, $10,000, and I think I said $150 dividend. In that particular case, if that company has a published dividend scale of 5%, all right, that $150 is the net result to that policyholder on a 5% dividend scale.
Right.
Here's the premium. Net. Here's the net. That's right. It is. You used the correct word, gross. That's a gross dividend, no question. But net to the client is a result of, in this example, a 5% dividend scale. Okay. Now, let's go forward 10 years on the same hypothetical example. I paid a $10 premium, and now the dividend is whatever,
500,
1,200,
1,200,
800.
yeah,
It's going to be substantially larger than 150. Well, that's not a 5%
Still
dividend
not.
either.
Yeah.
Right. If I paid in 10,000 and there's an 800 dividend paid, was that 8%? Is the first one 1.5%? No, that's a net result of a gross published 5% dividend scale. And so, but we can murky up the waters, and we can muddy the waters, and it's like, oh, mesmerize somebody throwing out these numbers, 5%, 6%. And then they're initially probably going to be disappointed, and then over time they'll understand, oh, well, it's not.
Should have paid more premium.
Exactly. So.
Yeah, and the guaranteed 4% thing, 4% of what? I don't know, but sounds a lot like APR. And don't worry, the APR on that mortgage is only 4.5%.
Yeah.
You'll pay 45% by volume. But don't worry, the APR is 4.5%.
America's going broke at 3%. Right? Oh yeah, everybody has a new car financed at 3%. Their credit cards.
But
10, 12, 14, 28.
Yeah, but my point is that the arbitrary number, the arbitrary selection of various numbers to make one instrument look more attractive, right? The guaranteed 4%, we try to make the whole life policy look more attractive. The mortgage with APR of 4.5%, you like to make that more attractive, right? We're choosing a number to make something look more attractive, when what really matters are things that are not enumerated, right? They might be stated elsewhere on whatever document, right? I'm talking about like elements of control, the degree of amortization, the actual amount of dollars by volume that you might lose in a given debt instrument like a mortgage. All these things matter way more. And so when we selling from the illustration, right, we can't get an illustration in the client's hands fast enough, we're just indulging that. No
question you're indulging that. No question you're part of the
feeding
problem.
into that.
You're part of the problem. Right. I mean, and the problem is the clarity.
Yeah.
And we always encourage, do your research, do your homework. It's okay to read a book. It's okay to watch videos. And it's okay to be able to separate the wheat from the chaff. And when you're looking at chaff, move on, just swipe left. But you have to have education, learning, understanding. And it's just like the IT world. And I don't want to crack on anybody. I love everybody, it's love, peace, and chicken grease. But when you're ignorant of like websites, I mean, it's like, oh my gosh,
the smoke and mirrors can be rolled out.
Oh, and you feel like you got loser on your forehead and pigeon, it's like, here, come take advantage of me, and I'll
take the money. Here's my checkbook.
Here, SEO. Here we are for X number of dollars. Forever.
SEO, APR, guaranteed 4%. We got to come up with a list of these terms, these buzzwords. Like, ran away. So a couple other things too. I think when people do talk about quantifying the value of IBC or trying to get a single quantitative metric, I think an implication often is that the two things under analysis are mutually exclusive, right? If I'm looking at the rate of return on investment A and I'm trying to quantify the value over here on the other hand of IBC, the underlying assumption is that I'm trying to choose between the two, right?
Sure.
The point is to compare, to
choose
contrast,
the best
and then
one.
select, right?
You're right.
Which is misguiding because with IBC, you can stack those things, right? And you won't have dollar for dollar liquidity, but you can get most of the premium payment in the form of a policy loan very quickly within a billing cycle, right? And you can use that money to then go do whatever else you're going to do anyway.
Wait a minute. How long is a billing cycle?
Well, I don't know, 31 calendar days.
I'm just asking.
Yeah, just give the company processing. Probably call it processing.
Give him time for the check to clear.
Right, exactly. So you can stack the thing. So people will ask these questions, and they'll take 8 minutes and tell me about all of their investing experience, and it's like, glad to hear it. It's very interesting for a lot of people's different investment advice. And in the end, is like, well, how does all that fit with IBC? And my response is, just do both.
Yeah, all that.
Just do both.
Yeah. Well, I like for my clients to understand. Look, life insurance is an asset. So, like any asset, we should understand how to manage, own, and take care of, and use the asset.
Yeah.
Right. So there's the education curve continues, and I mean, none of us wake up one day and know everything.
Right.
I don't care how many policies you own, you can learn, right? And then if you are learning, you should share, right? Shouldn't you? That's, my point is this, that I like for clients, and some clients, they like numbers more than others. Some are conceptual, you have the, God bless them. I don't care if you're an engineer. You can get it too, but it needs. Listen, I love engineers. I'm just okay. They're more analytical, right? So and there's nothing wrong with that. But if I'm going to compare a real estate portfolio to a bond portfolio, cash flows matter, right? So if we're solving for a rate of return, it's better to me to get to an internal rate of return, not just the annual 5% or 6%. What's the net internal rate of return to the owner of the asset? And that will take into account the time periods. We can cherry pick, 1 to 100 years or 1 to 10 years. That reminds me of Wall Street, cherry picking time periods. But if you have a real estate portfolio, those cash flows are going to be different than a bond portfolio, which are going to be different from an equities portfolio, which are going to be quite different from a precious metals portfolio.
Yeah.
Whether it's bullion or numismatic. I'm just saying, when you understand how to calculate a net internal rate of return, then you can compare asset class to asset class to asset class with clarity.
So here's, as you were saying that, this came to me. So I did that, taught that seminar recently on Nelson's book, right? And of course, we spend a lot of time on part 4, equipment financing, right? And at the bottom of the page on those illustrations in equipment financing, there's that highlighted number on, like, first column from the right, the cumulative net outlay, right? So what Nelson is showing is premium payments in of different amounts year to year, depending upon which illustration, and then the individual, the logger in this case, taking some passive income in the form of dividends and surrenders in the later years, right? And that's a outflow of cash. And then in the CD Sisters example, where he's talking about the various methods of financing a car, he shows that the individual took, I think, $50,000 per year in passive income, and he kills her off at 84 or 85.
End of 84,
right?
Or 85.
But mentions in there, had he not constructed the example that way, had he just let the individual live on, that individual could have continued to take additional passive income, far and away more than she put in.
No question.
Okay, so if we're truly present valuing, right, if we want to get a present value of future cash flows, consider that if you can live long enough, and if it's a non-direct recognition company and the cash value is continuing to grow year to year, and you continue to use your policy to provide some additional passive cash flow, either in the form of a policy loan or taking the dividend or surrendering some, if the growth dynamics are right and the company's right and the design's right, that can go on for a very, very, very long time. Okay, so if we want a true internal rate of return, how far out do you want to project that? And it's legitimate, right?
No,
if you make it out there that long.
The life insurance policies today go to 120. At the end of
121.
Then you're 121. It's like Nelson graduating the examples in his book, Becoming Your Own Banker, CD Sisters and Equipment Financing 2. There's illustrations in there, there's no question, and he's using them for an example. And I don't know how many times he said, if I rewrote or if I could do it all over, if I did it all over, writing his first book, Becoming Your Own Banker, I would not put an illustration in the book. And I think it probably has something to do with, our conversation today.
With this.
But at the end of age 84, we're just looking at time periods. And then, he graduates them at age 85. All right. Now, so the life insurance policies today, and in 2020, all of them, they still are all today, amortized, right? They use a 120-year life expectancy.
Yeah.
So they're built actuarially over that life expectancy. My point being is this, how long into the future do you want to go? Now, if we just look at your life, we're looking at 120 years of age. Oh, wait a minute. Young, handsome, smart, intelligent, intellectual. Look, every time we go somewhere and speak or whatever we do, there's at least one couple in the crowd that comes up and says, James, is he available? And I'm like, I don't know. Let me see a picture of your daughter. And it's like, maybe, maybe not. My point being is, there's some lovely young lady in your future. There's probably some little Mr. and Miss Griggs running around. And now we can start talking about generational. So life insurance comes with a death benefit. Mm-hmm. Death benefit is paid income tax-free to your heirs. Oh, wait a minute. If you live long enough, you're probably going to have grandchildren, great-grandchildren. I mean, how long literally do you want to go?
And what's all that worth?
Yeah, we'll put that on the page. How about the real estate deal that you made 20% on, right? Net. Where's that rate of return show up on the life insurance illustration?
Right.
It doesn't, but it won't show up on your margin account either. If you're borrowing money against equities, to go invest in real estate, people do that all day long, right? Mm-hmm. Yeah. Or maybe they're buying Bitcoin. I don't know. Where do you put that rate of return, on the margin statement? And the point being, the illustration is the illustration. Mm-hmm. The most important thing that you can do, in my opinion, and this is just encouragement, do what you want to do. But if you're going to put money anywhere, you should do your homework, do your investigation, do some betting, be able to separate the wheat from the chaff, and then, reach out, speak to someone who's competent, educated, able, and that is pleasant to work with. I don't know.
Yeah. And the thing that all of this hides, the rates of return and the illustrations and all that, the dividend scales and all that, is that what matters at the end of the day is that the individual policy owner's behavior will affect the results the most among all parties to the contract.
Yes. And also what a crafted illustration can hide is the structure of the policy. And there's little to no way for the consumer to understand why this life insurance illustrates differently than this life insurance illustrates differently. Very rarely do you see apples to apples, right? You have, just saying blended PUAs, for example, a pet peeve of mine. I can't stand them. It's an insurance construct, right? So what I mean by that, you can structure a policy to raise the death benefit, to avoid the MEC, and you can do that with term. We're trying to get as much money into the paid up additions, whatever the life insurance companies call their particular paid up additions, rider. We're just trying to get as much money in there as we can by the least amount of death benefit without foregoing your need for death benefit, because that's a
legitimate,
very, very powerful tool. So I'm just saying you should have some understanding on structure. Okay. And, somebody's playing games with numbers on a page, you can hide a lot of that.
Absolutely.
Substandard structure.
Substandard, that's a good pun.
Well, no, seriously. But at the end of the day, you can take a poorly designed dividend-paying whole life insurance policy issued by a well-run mutual company. I mean, that's my terminology, and there's a lot behind that. Ratings, philosophy, financials, a balance sheet. And you can still be okay. Right?
Yeah.
And it's because it's dividend paying whole life insurance.
All right. I think time is running down. Do you have any last thoughts that you care to add to the discussion of illustrations?
Yeah, we appreciate your comments. We appreciate you, tuning in and listening. And
more people are. How cool
it's
is
all
that?
that money you're paying for SEO.
Right.
I'm kidding. It's like
the major amount of money we spend, 50% of our budget that goes into marketing, right?
You have a budget? No, it's I have.
We really don't do any of that.
Sure, our contact information is down here, but we're promoting the idea that you can become your own banker,
right.
And the most legitimate, shortest path to that happening in your life is understanding, reading, researching, becoming your own banker as from the origins, right? Nelson Nash. Now, a lot of people in the life insurance world throw his name around. It's like, oh yeah, we know Nelson Nash. We've been doing that, and it's like, oh my gosh,
yeah.
And maybe some of them have.
Maybe.
I don't know.
Definitely read Becoming Your Own Banker. There's even a book review on YouTube with some familiar faces.
At least one, right? How many do you think are going to be out in the next 6 months? Book reviews.
I don't. We put 4.5 hours, 5 hours, and that was just what made it onto the different episodes, so the different parts.
I mean,
I don't see that.
I feel like a slacker when you say 4.5 hours. There's a lot of hours into that.
Well, that's how much eventually made it on the final cut.
Finished.
Yeah.
Oh, okay. Well,
that's what I'm saying. There was a lot more. Like, that was a lot of work.
Yeah, we shot that twice. The first time was like
3 times. Yeah.
Yeah, made some B-roll. I don't know.
All right. That's it for me.
Are you done?
Yep.
Thanks for listening. Put a bell up here so you can tag out. Ding.
Yeah, that's my verbal bell.
That's your verbal bell. Ding. All right. Thanks.